Record. All right, everybody. We would like to thank you for coming to the presentation of Horizon Apartments for our Big Dog family. I know many of you on the call, but just to let you know that I've been a Big Dog for 5 years now. I've been super excited. For those of you that don't know, my first passive investment and one of my first mentors was Sanjay, who's going to be presenting. And we've become great friends and then spent the last year together working with Massive Capital. And as you know, we presented several deals to the Big Dog community. We're really working hard to bring some great value and some good deals. So I'm going to pass it over to Sanjay. And again, we'll have plenty of time for Q&A at the end. And a copy of this recording will also be uploaded for the Big Dogs that came late or different times. So Sanjay, it's all to you now, my friend.
Thank you, Trevor. And we're very excited to present this Horizon Apartments. And as always, yes, we're presenting this to raise funds, but for Big Dog family, please feel free to ask any question. There is no stupid question. Kind of agenda for that. We have an agenda, but put it in the chat. We may probably take the questions at the end, and we'll unmute to have a chat, to speak, whatever you like. So here's the agenda to what we will go over. Before we start, we are not lawyers, financial advisors, or accountants, and we do not give any of those advices. So please consult a lawyer, CPA, or a financial advisor for that. This is a SEC exempt offering, but it is a security offering from a legal perspective. Okay, so just a high-level summary of this apartment complex. It's our purchase price is $16.9 million. It's a C-class building with a C+ location. We think that area is gentrifying very quickly. The $16.9 million amounts to about little under $83,000 a door, which is little over $95 per square foot. Total equity we are raising is $6.6 million. When you get the PPM, it actually shows $7.2 million. We're really, originally we were needing to raise a little bit higher amount, and we will talk a little bit that our supplemental came in higher, so it reduced a little bit, but we're leaving the PPM at 7.2. But the calculation that I showed here are at 6.6 million. We're projecting a 7 to 8% cash on cash over the life of the deal, meaning 7 to 8% annual average. 18% IRR, 2.1 multiple, equity multiple, 5-year hold. All these numbers are based on a 5-year hold period, and it's a 50% minimum investment. Again, if you don't know, or if you're relatively new, the difference between cash on cash, IRR, or equity multiple, those three things serve a little different purpose from assessing an investment and what might or might not work for you. We can please raise your hand, and if you don't know it, there are other people who don't know it, so we can talk about that at the end in detail about that. It's in a San Antonio market. We are having assumable loan at 3.78% with 2030 at the end of 2031 maturity. So for any of these deals, the most important thing always is the sponsor team. As I always say, a good sponsor team can make a bad deal work. Most of the time, not always, of course, but a bad sponsor team can ruin a good deal, right? So sponsor team is your one of the most important thing you should look at from investment perspective. So TVG, Texas Value Group, Massive Capital, and Golden Ratio with Amber and Janae, they're on the call here, are kind of the main GPs on this deal. For Massive Capital, we have 3 partners. I'm a Big Dog since 2016. engineer by education, and then kind of fall into banking after business school. And 2016, when I quit my full-time job, joined Big Dog, and I've been doing real estate. Started with single-family flips and started multifamily in 2017. Schreier oil, energy and oil background, very financial savvy, worked in that industry for a long time. He also quit last year, and now he's in full time with with Massive Capital. Before that, he bought land and bought and wholesaled and flipped and does all kinds of things mainly for the land. And Mike Bailey, another big dog from Big Dog community. That's how I met Mike Bailey, and how I know him is through Big Dogs. But oil and gas industry veteran, he retired into 2021. And when we met in 21, and then finally we got in on 2022 with Massive Capital. So he has co-sponsored various deals on his own before Massive Capital, and has a variety of experience. Similar for Texas Valley Group, Jose goes by Nacho, Jose and Vinny. They own assets in San Antonio locally. We got connected with them through one of the other networking groups, and they operate assets in San Antonio as well as other markets, so have a very good experience. So they're raising equity from Mexico as well as in US, and driving this. So just at a high level for the sponsorship team, we've had 20 deals amongst all of us combined, 7 full cycle, more than 3,000 units under management currently, a little over $500 million, and asset owned in these markets. So I'll let Amber and Janae introduce themselves a little bit. Also, for those of you who don't know, I've known Amber and Janae for a few years. I've seen them do the deals, and very happy to see them, kind of work with us and come help us on these. So Amber, Janae, you guys want to go introduce yourself?
Yes, thank you, Sanjay. We are also very excited to be working with Massive Capital on this one. For those of us that don't know the two of us, we are Amber and Janae. I am the Janae, she is the Amber, and we collectively were designated Jamber by Big Dogs. We became Big Dogs in 2019. And we worked for about a year and a half and just busted, did 40 some odd different types of single family assets. And we got to a point where we just really needed to duplicate ourselves, find more hours in a day, or hire some people. And after working in family businesses before, I knew I didn't want to necessarily be an employer. So we tried to find ways to grow our business, and found the multifamily space, and are so grateful for that. We have been working in the multifamily space, and we have multiple assets. And I think she and I, and some of these are combined with Massive Capital, we have something like 2,500 doors now, about $130 million under assets under management. So it's a great program, and we love working with Massive, and the TVG team on this particular project has been amazing to work with. So we are just really grateful for the opportunity to partner with Massive on this one.
Thank you, Janae. Amber, you want to say something?
Oh, she can't unmute. Trevor, you need to unmute her. She's waving. Well, I wondered why she was so quiet while I was talking. Most people that know us really well know that I start talking, and then Amber kind of likes to interrupt me. So
there we go.
She was very quiet. Now I know why.
There we go.
I'm going to tell you
for that,
truth.
Janae.
Janae paid me $5 to keep her muted.
See? Thanks, Trevor.
I see how it goes. Anyway, no, that was awesome. Janae covered all the high points. I just wanted to add that we love Big Dogs. That's changed everything for us. And we did our first investment through Canis Major. I can't remember if it was 3 or 4 years ago as a passive investor. And And that's when we saw the light, moving away from single family a little bit, and we just started really switching gears. So, and it was amazing to have this team of big dogs that we already knew. And so it was just a natural fit for us to be like, hey, pulling on their coattails, like, can you guys teach us everything you know? And so we're trying to learn just as fast as we can, but we've grown very quickly, and it has a lot to do with the folks here at Massive. So we're excited to be on this deal. And that's just what I wanted to add about that.
Thank you. Yeah, awesome. Very excited. And of course, in addition to the sponsorship team, the relationships and the vendors mean a lot because they do a bunch of the key tasks. So in addition to the TVG group, Wells Fargo is the servicer on this. CMI, the property tax litigation company that we do use, and they kind of go across the board. Madison Spec does the cost segregation across all our assets, and we kind of negotiate the pricing for those. Seth and Alexander is the CPA. They do accounting across all our assets. The property management company have their accounting, but the accounting on the asset side is done by Seth and Alexander Group. Robinson Franzman, Todd and his team is the syndication attorneys we use. So they put together all our SEC documentation, PPM, OA. And then we have the Sergio Chavez, another attorney for some of the offshore legal documents that for some of the investors from Mexico, as we might have joined. So they're going to handle those some of those legal documents and stuff. So all of these are established relationship, except maybe Wells Fargo, since as a servicer, this is the first time we're dealing with them. And UAG, the property management company, UAG owns 3,000 plus doors in San Antonio and operates it as a property management company. So very good experience in the local market. So after interviewing 2 different property management companies, we picked UAG as our choice. So property overview, it's a 204 units built in 1974, and seller has rehabbed a lot of the units, almost all the units in last couple of years. It's a garden style multifamily with 2 stories. The purchase price we talked earlier, it's in the northeast side of San Antonio, just off of I-35. Occupancy when we got into contract was above 95%. Just one picture of this apartment. So from a location perspective, this is the I-35 410 from San Antonio. So right off of that is this apartment complex. You can see on this map some of the H-E-B distribution centers that are there, and Janae will talk a little bit about the market, but this is quickly gentrifying area for this. So our business plan of value add for this property is, we kind of split it between interior and exterior. So for interior, we're doing the 28 units that are left over, that are the classic. So we'll continue the conversion of those units. So and kind of the story behind this goes is, originally we made an offer on this property back in March. When the property first came through our network, actually Trevor, I pinged Trevor since Trevor's in Austin, and Trevor called Amber and Janae, and 3 of us was like within 24 hours, they were at the property with the seller walking the property. And seller loved the 3 of them so much and what they heard about our team and everybody, that since March, the seller was asking 21 million. We were at below 17 million on our offer. They kept coming back to us because they really loved the team and what they saw. But we stayed firm at our offer price, and the seller did have it under contract at 19 million, and it fell through because they couldn't close with the lender. We are going through that now, and we'll see. Hopefully, fingers crossed, we can pull that off. So far so good. And then they came back in September, the seller like, hey, let's go with this team. It's a good team. And that's where we got into contract. So this is a seller, you know, she kind of owns the assets herself and operated by herself. Very hard worker, very shrewd on her operation and operating capability, but she's doing everything herself. She started to network within the multifamily space, so she's learning. But I think she did some sort of a water conservation, but not a full-fledged. And you look at the average usage, and you can tell right away that there is a opportunity to reduce the water conservation. So that's a big part of utility reduction, cost reduction is a big part of our plan. We can convert a couple spaces into new units. Again, you know, when we see it, it's like a no-brainer to do that. The math just makes sense, and she just kind of left those that space there, and of course the 28 units. On the exterior, you know, we have some, you know, just the general maintenance of roof, siding, patio, parking lot, some LED light that kind of feeds into the utility cost reduction, curb appeal. Generally not a bad curb appeal, but we think we can do it better. Some upgrade for playground, and then adding some parcel and storage units and lockers, and again adding some signage. So, you know, just this, doing some of this value add and operating with a professional property management company will kind of deliver our business plan for this. And the seller's managing herself. She directs the manager and maintenance guys and everything herself directly. So, and here are some pictures of the units. All the units have a tile floor. So, you know, the flooring cost as the tenant turn and anything happens is lower, which is a great thing. And here are some of the upgrades that the current owner have done, you know, adding the knobs, doing the black appliances. This one doesn't show the backsplash, but there are the backsplashes, and then just a nicer tile around the bathroom tubs. Other potential revenue streams for the package locker, potential storage units for a lot of the space that's there. Of course, we will need to go through the permit and that process. So you know, we'll see how that goes, but that's a potential. Spectrum, the technology package that the seller has already implemented and charging the tenants already, and the parking that electronic parking system that she implemented and is already underway for revenue that will continue to grow for us. In our underwriting, we have not included the additional revenue from the storage and the package locker, as there is some uncertainty on those. But I think if we can pull that off, that's a huge upside from a revenue stream perspective. Here's some of the layouts for the units. It's a very good mix of 1, 2, and 3 bedroom units, which, you know, makes your marketing that much more efficient if you have all mix of units, because when the tenant comes, they could be for any of these, and you take their information or lease them a unit. So a little bit about the market here, and I will let Janae talk about this market.
Yeah, so as we look at these market, the market overview in the area between San Antonio and Austin, one of the statistics, oh, you can go back to that first one, Sanjay, that's fine.
Okay.
Is that, yeah. Perfect. Sorry, I lost my total train of thought. So why we're, no, that's okay. In the area that we've got in San Antonio, there are a lot of businesses that are there, and we are positioned very, very well with the growth that's going to happen in that area, because this is a property that we typically see people who are in the workforce living in. It's very well positioned to continue to be occupied at almost 100%. So that's exciting for us. Okay, Sanjay, I'm gonna have you pop to the next one. San Antonio is the 7th largest city in the US, and we have major employees and corporations that are down there. So we are, again, very well positioned in the area because of the workforce demand being close to these entertainment and business centers. So in the area between Austin and San Antonio, we know that by looking at studies that by 2045, 53% of the population is going to live within 5 miles of I-35. Our building is just right off of I-35, so we're going to be able to capitalize on some of this growth. We also have learned that in that corridor between Austin and San Antonio, the growth rate there is going to continue. I think it's going to grow by 2.5 million people by 2030. So the growth rate in this area will help keep this this property fully reaching its capacity. It's amazing. Again, we've got lots of employers in this area. Big things, HEB, by the end of December, we'll have the new plant open, and Amazon coming into town, building 3 new facilities in this general area is just showing that the growth in the San Antonio market will continue. So it's a strong economic driver in this area.
Thank you, Janae.
Mm-hmm.
And you know, generally, San Antonio is a relatively smaller compared to Dallas and Houston in Texas markets, and all the things that Janae shared. You know, we are very bullish on the San Antonio market despite the real estate cycle that kind of goes in and out from a population growth perspective. So from a business plan perspective, the first and foremost is, implementing the professional property management company. So UAG will take on, they were there with us for due diligence. They are already planning to take over the property and all their staffing and everything else. We will be looking to add one second, sorry guys. Okay, sorry about that. Okay, let me switch this here. Okay, and then we have the other revenue initiatives, so incremental rent increases to the market. The current owner doesn't really do a whole lot of marketing. So as we do the marketing and bring in, we already discussed with UAG marketing to these HEB, the warehouses, these places, to bring in more potential tenant traffic. Storage unit, the package locker, tech package, and the parking lot that continues. Then implement the utility reduction plans, so water conservation, the LED, the electrical contract negotiation, which is already confirmed. We will be reducing. We will have 6.25% less over the seller's electricity cost. Just the curb appeal to increase the appeal for the property. Rehab and turn the additional unit and continue to increase the rents, and then eventually put it up for sale. So how does that business plan translate into projected investor returns? So if somebody invests $100,000 just for a simple number, we actually expect a little over 5% cash on cash in year 1, and it goes up as we implement all these programs and the savings that got implemented. And of course, if we were to exit in year 5, then profit from sale. Um, so so the total this is an error, I think, but the total multiple ends up being 2.1 overall, and this calculation here doesn't add the cash flow from these 4 years. So that's what we had in our Excel correctly. So that's the average, 7 to 8%. And when you take the average across the 5 years, 18% IRR by the time this is all said and done. We do have a 70-30 split with the LPGP, and we are putting a 7% preferred return. And what that really means is we will not be distributing anything to the GPs until the 7% pref is met to the LPs. So just to make sure our interests are aligned, and we put our LP investor interest first. We do have a cost seg study estimates done. This was done for this year in 2023. In case it ends up going into the next year, this will go down because the next year the amount of depreciation, bonus depreciation goes down. So you know, we should have some confirmation on this over the next few days. But with these lenders, there's always that risk of going into the following year. But if it closes in this year, we have an estimate of 43% on your invested capital in 2023, and then additional 42% over the following 5 years from cost seg. Sources and uses of the funds. So, you know, 16.9 is the purchase price. So our down payment is 4.17. 1.16 is budgeted for the CapEx, closing costs, acquisition fee, just under 600,000. And then we will have some reserves of 660,000 just in case we have any unforeseen expenses. From a financing perspective, we are assuming a Fannie Mae loan that was originated in 2020 with a 30-year life cycle. It did have a 3-year interest only, which has already expired earlier this year. Originally, it was a 75% LTV, 3.78% interest, which we will inherit. And we will have about 8 years left on the term of this loan. Because the loan to value was lower, we are able to secure a supplemental loan, which brings the total LTV to 75%, basically. So the final terms on this end up being a little bit higher. It's at 8.6%. And actually our proceeds are a little bit higher at around 2.6 million, but slight changes on this as we move around. But no changes to our returns for investors from that. And we like to be 100% transparent. So from a transparency perspective, all the fees that are charges to outside of the expenses, the fees that are charged. So it's a 70-30 split. So 30% goes to the sponsors as a carried interest, and the 70% will be owned by the LPs. We will have an asset management fee at 2% of the gross income on a monthly basis. We will have a 2% acquisition fee of the purchase price. So this is the 2% of purchase price. At disposition, there is a 1.5% disposition of the sale price there. And again, there is a project management fees of 5%, which may be the property management company or us, or we may hire a project manager. But all these fees are there, but all these returns that are shown here are after paying all those fees. So these are still the returns that are projected for the investor perspective. And all of these, except the asset management fees and the acquisition fees that are pays at the front, like the 30% carry is only paid after the 7% pref is met. So this one, disposition fees are not paid until the 7% is met. So here's our detailed pro forma that went behind all the calculations for on the previous pages. So Amber, I'll let you talk through these. Go for it.
Excellent. This is my favorite part. For those of you who love the numbers, you'll want to tune in here. If you don't, you might want to tune out. But this to me is where the deals are made. So you have your first column there is the T12. So that's the sellers, what they've done in the last year. And then across the top, we have our rent and expense escalator. So the first thing I want to point out is that year 1 and 2, excuse me, sorry about that. Year 1 and 2 rent escalator, we're really, those bumps there are really just bringing these rents to market. So it's not like we're at market and what other people in the area are charging. We're just that 6% and 5% respectively is just kind of getting us up to speed with what's around us. And then we're treating it very conservatively year 3, 4, and 5. Same thing with the expense escalator. It's very conservative with 3% expense escalation in year 1, and then 2%, throughout the end of the deal. So a couple of points that I want to hit on, like I could do a whole hour on just this slide, but they won't let me. So I'll try to keep it brief here. A couple of the things that we want to mention. Other income is one of the ways in which we are increasing our bottom line, the NOI. So we're doing that. Sanjay already talked about the parcel lockers, the storage units, converting some of the there's storage space right now that could be turned into up to 3 different apartments. So flipping some of those other things, there's parking, and there's the cable package to where we see that we're going to add this extra income. So we've gone over that with a fine-tooth comb. And, it's a small increase as well, but we think that we can easily deliver on that other income line. Some of the expenses that I want to talk about, probably real estate taxes are something that everybody in Texas is concerned about. And they just came out for San Antonio like 2 days ago. So we found out that we're actually getting a significant break on that number that's in there. So we haven't changed that in our underwriting. So because we've been conservative, that's just a little extra money that we're going to have in our NOI. So, and as always, we try to have, if we're going to have surprises, we want to have them on the positive side. So that was a nice thing that actually just came in a couple days ago on the taxes. So we feel like, well, we don't feel like we know, and that's actually without the tax protest, so which we will also be doing. So we expect for that discount to be even greater. If you have a keen eagle eye on this stuff, you probably zoomed in on the insurance cost difference between the T12 and year 1, and it actually went down a significant amount. And if you know anything about insurance, you're probably like, why is that happening? So let me talk about that just very briefly. The insurance from the T12 was from the seller's previous year. She just renewed, I believe, in September, and her new renewal rate was $87,000. So that's not a projection. That's a real thing. That's her bill. That's what she's paying. Since we are assuming this loan, we've been in touch with that insurance company, and this is a real quote for us. So we believe that this company is trying to gain market share, and so they're willing to kind of go low on the first year. But if you look back at the second year, we're assuming that they're going to kind of bump us back up to what it was. So again, we feel like that's still very conservative, and we're excited to have gotten in with that rate of insurance with State Farm on this. And because it's an assumption, you know, they're carrying the property right now, and they're going to continue to carry it. So we feel super confident that that is a real number. And the rest of those numbers are fairly conservative. You know, we have slight increases in the rest of those numbers. So again, we just feel that it's very conservative. We have conservative increases across the bottom line on the NOI, and feel super confident that we can deliver.
Sounds good. Thank you, Amber. Just a couple more things, if I can add, to highlight the utility reduction that we were talking about. That's a key part of our business plan. It's built in there. We already have the quotes for water and sewer that shows we can achieve this. For utility, for electric, it's about a 10% decrease here. 6.25 is already there. Rest is with the LED and other things. So I think it's a very achievable pro forma here for us. So some of the rent comparables, as you can see on the map, there are not a lot of exact properties on this side of 35 for us to pick for comparison. So there are a few that we picked in the market with a similar vintage. And this property from $1 per square foot is definitely on the lower side. And from a total absolute dollar perspective, you know, we have room to increase the rents on our 2 bedrooms, definitely, and others. From exit strategy, you know, 5-year, of course, that's how the deal is underwritten. If the market switches, interest rate drop, and something happens, we'll definitely consider early. But on a 5-year plan, you know, we have a 6% exit cap rate for this. So in year 5, the NOI, putting the property exit value there, considering everything else, kind of shows. A little sensitivity study here from 6 million is where we are looking at. If we could sell a slightly lower, there is an upside. If we do have to sell it at a little bit higher, of course, it erodes into the profits a little bit, but we're still in the positive territory from a overall perspective for the property. Because we are getting in at about 17 million plus another 2.5 million total cost for us. So we still have an upside even at a 6.5%. So from a timeline perspective, you know, as of now, the timeline is our closing date is set for December 7th. 506C, this is a 506B currently. We are planning to switch to 506C on 21st, right before Thanksgiving. You know, if timeline may change slightly, but it is for now. It is that's where we are at. That's all the prepared material I have. Trevor, back to you. Any questions or
Awesome.
open for Q&A?
So I think I've set this right that anybody can unmute and ask a question. There was one question that came in the chat about population growth. And so I actually Googled it and put the answer in. Thank goodness for Google. And then one thing I do want to say is I actually have a property 4 minutes away, and it was actually one of the rent comps. So I know this area very well. And I always refer to San Antonio as baby bear's porridge. It's never hot, it's never cold, right? Dallas, Austin, Houston, sometimes those markets go through swings. San Antonio is an awesome, steady market. It really is. It's a true workforce housing market. This is a true workforce complex it's in a nice area that's growing, has a lot of potential. So that's my 2 cents. Michael's also joined us, so we welcome here. It is currently.
Thanks, Trevor. Appreciate it.
And this property is currently considered a C, and we plan to make it a slightly nicer C, is a better way to put it. We're never going to make this anything more than a C plus. And I would say right now it's probably a C. It's a solid C to a C minus. Yes, David. Hopefully you can unmute yourself.
Yeah, yeah.
There you go. Thank you.
Microphone test?
You should be good.
Okay, that's got it. So my understanding, hi, so this is actually my first presentation like this, so some of my questions might be a little juvenile. But so my understanding then is that San Antonio does not experience swings, or if it does, it experiences them in
So,
a much smaller.
Everywhere
roller
has
coaster?
swings. It's just not as volatile as some of the markets. So you know, Austin will, you know, even on property houses, they'll jump up 20% in one year and then drop 4 or 5% the next year. San Antonio is a much more
Okay.
steady market, is how I'd like to refer to it.
Okay, cool. All right, cool. Thank you.
Yeah, no question is a novice question. They're all more than welcome. You know, because part of this too is, you know, we love educating people. And so don't feel like, oh, I'm not going to ask that question. Because, you know, as part of the joy of being one of the big dogs is you're always learning. And I did put my contact info at the beginning. I'll put it again at the end. And even if you just want to connect and learn more about investing in multifamily, I'm happy to do it. It does not have to be about this particular call. And Michael has also posted
Perfect.
where you can get our deals.
Yeah. Yeah. And as just as a
Oh, yeah.
reminder for some of those that are maybe, you know, new to this, you know, the investor portal that you know, that we have, you sign into, there's no commitments in there. There's no risk to signing up. It's just, you have to have a password. But the good thing is once you sign up, you get to see all our deals. And the more we get to know you, at least you see all our Class C deals. And the more we get to know you and have the relationship, you see all of the Class B deals, or not class, sorry, 506B deals and 506C deals. So thanks,
And
Trevor.
for those that don't understand, a 506B, a sophisticated investor and an accredited investor can invest in. Once this deal switches to a 506C, you can only have accredited investors invest. So that's the difference between the two. And so Glenn asked a question about any current problems with the tenants. So when they first took over this property, they definitely had some, but she has done an excellent job of cleaning up the property. She really has. And you can see it in some of the Google reviews when you look at it. Of course, we hope to do better, but it's been she's got a really good solid tenant base right now.
Yeah, and she installed the cameras. So those are there, and of course, lighting up the property well and all those things contribute so property is lit well and taken care. And you know, you don't take anything, you get the problem tenants out, issue the violation, which you know the current owner is there daily and taking care of that.
Any other questions?
I have a few
Sure.
more. I just didn't want to rattle them off all at one time. So you are locked in for 5 years, correct? There's no early pullout?
That is correct.
Okay,
Syndication investments are illiquid. You have to
Okay.
stay in until we sell.
Okay, cannot pull. Okay, cool. Okay, I have to go through my notes and find the other ones.
Awesome.
Thank
All
you.
right, Mary, let's see, you should be able to unmute yourself. If not, I'll do it there. Looking forward to talking with you on Saturday too.
Yes. Hi, Trevor. Caught me in the kitchen again. I have a couple
Kitchen,
questions.
are we having spaghetti again?
No, we're not.
We were on a
The
call last
spaghetti is
night. And
gone.
she was cooking spaghetti and we kept her so long that meatballs
No,
went
it
to
was
meat
like
sauce.
7 o'clock. 2 questions. I think I missed it. What was the occupancy rate right now on those apartments? That's number 1. I'm sorry I missed it.
Yeah,
And,
it's around 95, 96% currently.
okay, and what's the percentage of units that have already been renovated?
So there are 28 that are left. Rest are all done. So whatever, yeah, 170 some units has already been renovated.
Got it. Those were my two questions.
Okay, good. Good
Thank you.
question. Yeah, thank you.
Yeah, it's a very nice property. We actually were fortunate when we did our due diligence, we invited a few of our big dog friends to come and walk the property with us, and it's always a very enlightening day.
Yeah, and you know, we showed up with our UAG property management and us and the team, and Sullivan was impressed that, you know, we had full force on that one day to get it all done. Previous buyer that she had in the contract with was her comments was very lackluster. They kind of two people showed up, and you know, it's a 204 units. You spend 5 minutes in each unit. You know, that's like 1,000 minutes, and you convert that into hours. You know, it's like a whatever 20-ish hours of work, just the units. Then the lease audit, and also, so she was impressed. She was happy with that, and that's where we are at.
So, I'm actually glad we're at this particular slide because I had a question regarding this. So basically, as the years go, the return on investment is going to increase, yeah?
Yeah, so good question. And there are a few different things to it, right?
Okay.
From an absolute cash perspective, you know, let's say right now you outlay cash is 100,000. We're projecting to give 5381, 7530 in those years based on the underwriting on those pages. And we calculate these percentages based on original 100 just to keep it straightforward and simple, right?
Okay.
And then, you know, in the year 5 from quarterly distributions, we expect to distribute this. And if we were to sell it, additional 71,000, and the total across these 5 and this would be, it'll be 220. So if you were to calculate, and the way the CPAs do the K1s, this is shown as a return of capital, meaning, you know, if you close this year, you get the 2023 K1, it'll show, you know, you had 100,000 investment that translated to certain percentage ownership, and the depreciation lowers that, right? So net, it shows the loss. No, year 1 won't show a loss, but it shows a less than 100,000 investment. And the year 1, you know, next year when you get it, your investment will show a reduction by that amount because we show it as return of investment. So this is not, as per our understanding, taxable. But, you know, depending on individual circumstances, it could still be taxable. So, you know, please consult the CPA on that. But we code it as return of original investment, original capital, and it continues to go. But our calculation here is based on original this thing. And on your side, you're right, that if you say, hey, I got this back, I could invest this, so my actual percentage is higher, which is reflected in the IRR. Because IRR has a time component to it. So if I was returning 20,000 here, nothing here, and then these things, right, IRR would be higher because I returned something sooner. Annualized return, which is a linear average without the time component to it, comes out to this, which is you really just take this multiple, divide by 5, and that's what it comes out to. But IRR has the time component that you're thinking of built into it.
Okay. All right. Good.
Great questions.
Thank you. I was raised by an accountant.
Nice.
And so that amount per annum we don't have to wait until the end of the 5 years to get that, right? It's going to be a payment per year, right? Or is it payment
This-
per month, or how is that?
This is what we're projecting to give out, and we will likely
Okay.
usually do on a quarterly basis.
Quarterly, I understand. Okay.
Yeah, so quarterly, this one would be, if somebody invests 100,000, we're projecting to pay out a little over $1,250, right? That's
All
what it's
right.
like. And then it goes up slightly that year, goes up a little more as the cash flow improves.
All right. Good. Okay, thank you.
Yep, you're welcome.
Then my last question, at least currently, was so why does the current owner want to sell? I mean, it sounds like she's just looking to get out of it, or
Yeah, so, current owner got the property in a pretty bad shape. She cleaned up, she did the units, she cleaned up the tenants, she got it leased up. So she did quite a few things and added the value here. They've been doing everything on their own, like literally property management, rehab, managing the crew, or hiring, firing, all of that. And she started learning about the, Canis Major and Lifestyle, all these other groups. And they're realizing they can partner and they don't have to do all this. They've got, what, 4 or 5 kids. So, that's getting on them to pick up and drop off from kids' activities is there, right? So they're looking to just, cash out, get a little bit better lifestyle, and then partner with other people on deals as opposed to doing everything on their own so they can focus on their own,
Yeah.
kids and life also.
okay.
And even at the reduced sale price, she is making good money. She bought this property in what I would refer to as distress, because I actually looked at it 3 years ago and passed on it myself. And she has done a really good job taking it out of distress, but she works day and night.
Mhm.
When you're managing a property of that caliber with that much renovation,
And
I
that many
spent
kids.
hours talking to her during due diligence, and she's just tired and ready to move on and wants to do deals where she's not the lead sponsor. And we actually think we'll get her to reinvest with us as the lead sponsor. She's been very, very open to that.
Okay. All right, very good. Okay, well, I think that's my last question. Thank you.
Good questions. Thank you.
Awesome. Anyone else? Put the rest of you to sleep? Well, awesome.
Well, feel free to unmute yourself, ask any question. No question is stupid. This is the time. This is a safe place. Please ask anything. And I love to see some of our big dog faces. So turn on your cameras, guys.
Hi, Maggie. I think I'll let you introduce your, there you go.
Thank you. I have a question. So you're raising 6.6 million, right? And how much money are the general partners bringing into the deal?
Yeah, so typically we invest, so like me and Schreier are guaranteeing the loan. It's a non-recourse loan, but we use our balance sheet and liquidity. So from a Wells Fargo perspective and Fannie Mae perspective, we're committing to input at least 100,000 between the two of us combined, our money. And the other GPs, they may invest their own money just because we like the project. And we kind of keep it until the end, depending on how much we raise and where we land on this. So there's no hard commitment beyond that 100,000, but likely we would have more.
Thank you.
Yep, you're welcome.
Is there a minimum investment coming from us in the sense of like 100,000? That's up there for per person. But is there a minimum?
50,000 is the minimum for LPs.
Okay.
Yes.
All right.
Not the slide. We had a slide on that. Minimum is 50,000.
Minimum is 50,000. Okay.
Yeah.
Thank you.
Yes,
One
and
other
the
question.
information will come out on an email as well. So you'll get a follow-up and anybody who wants more information or a copy of this deck can reach out to me directly. I'll put my email here in the.
Excellent. Thank you.
Yeah, and the last thing, between the accredited and non-accredited, if you know you're not accredited and you are a sophisticated investor, right? Then you fall into the 506B category. That means the commitment has to be done as per the current timeline. Commitment has to be done by November 15th, meaning the documents in the portal, our cash flow portal, has to be signed. Funding can happen after still, right, Trevor?
That's correct.
Yeah.
And one other point of information too, if you're accredited, but you hate sending some stranger all of your financial documents, you can self-accredit while we're a 506B. And I know personally, I would much rather just self-accredit myself. So you just click a button saying I am accredited versus have to get a third party to verify your accreditation or an accountant.
Yeah, and if you don't know you are accredited or not, and are you sophisticated or not, please reach out to Trevor, me, Amber, Janae. We're happy, or Mike. We're happy to talk through and give the guidance. And you can determine from an annual income or net worth perspective where you are and where that would fall.
Okay, so Trevor, we'll definitely be in touch then pretty soon here.
Awesome.
All right, thank you.
Yeah.
Where about you located, David?
Well, I am in the Dallas region.
Okay.
Yeah.
I am in DFW, David. So.
Oh, you are? Okay.
Yeah.
All right.
And I get there every once in a while. We usually have something going on. We have a big in-person event coming up. So that's coming up in February in Dallas. So
I would okay. All right. I would certainly like to take a look at that.
Awesome.
All right. Thank you.
What other questions, guys? Anybody?
Oops, my ink just dried up.
one more thing too, while we're here, I'm going to do a shameless plug because I have to do a shameless plug once in a while. So tomorrow, Massive Capital is having an all-day virtual educational event. And because you are all our fellow big dogs, I just sent you, don't let Mike see this because his head will start to spin, a free code to get a VIP ticket for free, which means if you can't attend the whole day, you'll get copies of the replay. So if you're interested in joining, it's all-day event tomorrow. You can sign up at that link and then you use that code that I put in there. And hopefully you can join us.
Awesome. Thank you. I appreciate that.
Yeah, it's a good place to learn a lot.
Yeah, and thanks, Trevor, for that. It's a virtual event, online, but we got this platform that kind of makes it look like a conference, but really, it's kind of Zoom on the back end. But it's a really nice platform. We love it. So would love to see as many of you there as possible.
Awesome. Well, we've taken up an hour of your time. We thank everybody for listening. If we'll do one more call for questions, and if not, feel free to reach out to us individually. And we love talking to big dogs about real estate.
Yep.
Awesome. Thanks, Janae and Janae and Amber, affectionately known as Jamber. I now can tell them apart. So it's funny joke. I met them for like 2 years at events all the time, and they're always so nice, but I couldn't remember which one was which. And so they're Jamber. That way I didn't make a mistake. It was kind of funny. I'm sure they saw the panic in my eyes. Which one is this? I'm not the best with names.
Yeah, that's hilarious.
Awesome. Well, thanks everybody so much. We really appreciate you coming out and listening to our presentation.
All right.
Thanks,
Thanks,
everybody.
everybody.
Have a
Thank
good
you.
night.
All right, good
Good
night.
night.
Bye.
Bye.